This is ShadowQuant Stocks, brought to you by AresLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Wednesday, August 12, 2026, and this is the New York pre-market. Now, let's get into it. The S&P 500 is grinding lower, but if you look closer, the market is telling a story of divergence rather than broad fear. While the Nasdaq and the S&P are in the red, the energy sector is surging and small caps are actually gaining ground. Is this a rotation into safety, or are the big tech stocks simply running out of steam? We have the Consumer Price Index due out tomorrow, August 12th, and that is the shadow hanging over this move. Let's get into the data. On the economic calendar, the headline risk for this week is the Consumer Price Index, releasing on Thursday, August 12th. This is the primary inflation gauge the Federal Reserve watches. If headline inflation remains sticky above the 2% target, it keeps pressure on the Fed to hold rates steady at the current 3.63%. We also have initial jobless claims and the Producer Price Index on Friday, August 13th, followed by retail sales on Monday, August 14th. For equity traders, these are the dates that will dictate whether this risk-on regime holds or cracks. Apex, what is the single most critical variable to watch in these prints?
The absolute variable is whether the CPI print confirms that inflation is cooling, or if it reaccelerates. Given that core PCE is sitting at 3.29% year-over-year, and the yield curve is flat with the 10-year, 2-year spread at only 48 basis points, the market is fragile. If tomorrow's CPI comes in hot, we risk a rapid repricing of that flat curve, which would punish duration-sensitive assets like the Nasdaq immediately.
Let's look at the tape. As of the close on August 11th, the S&P 500 via SPY is at $77.56, down 32 basis points. The Nasdaq 100 via QQQ is at $71.85, down 34 basis points. The Dow via Diamonds is at $53.28, down 32 basis points. Meanwhile, the Russell 2000 via IWM is green, up 34 basis points at $300.99. Sector rotation is stark. Energy via the technology sector is up 1.25%, and utilities via the utilities sector are up 1.16%, while technology and consumer discretionary are in the red. The top gainer today is LSPR, up 132% on volume, while the biggest loser is FNGA, down 95%. In the pre-market, we see significant moves. Kava is gapping up nearly 19% on growth news, and Micron Technology via MRVL is up 4.7% on AI memory product news. Conversely, Neurocrine Biosciences via NBIX is down 5.6% on clinical findings, and Corning via COR is down 17%. Let's break down the sector rotation first. Let's start with the energy sector via the energy sector. It's up 1.25% today and has gained 4.12% on the week, leading all sectors. Grid, what is the technical structure here?
Technically, the energy sector is showing clear relative strength. It is trading at $60.93. Looking at the price action, it is pushing against recent highs near the $61 level. The volume on the up days has been consistent, suggesting institutional accumulation rather than just a short squeeze. It is holding above its recent support zone, which is roughly the $58 to $59 area. The chart structure is bullish, with higher lows forming on the daily chart.
From a flow perspective, the COT data for crude oil futures shows commercials at the 100th percentile, which is historically a bullish signal for the underlying commodity. That institutional positioning is flowing through into the equity sector. We are seeing a rotation out of growth and into hard assets. The smart money is positioning for potential supply constraints or geopolitical risk, and the energy sector is the primary beneficiary.
I want to stress test this. The energy sector is up 4% this week, but look at the volatility. The implied volatility rank for the energy sector is at 98, which is extremely high. Options are expensive. This suggests the market is pricing in a significant move or a spike in oil prices. If geopolitical tensions ease or demand data from China softens, That high Roman 4 could crush the option value, but the underlying asset might not drop as much. You are paying a premium for upside here. Is this a structural trend or a temporary fear trade?
The trend is structural, the volume profile supports it, but I agree the Roman 4 is elevated, so entry timing is critical.
Moving to the other side of the market. The technology sector, tracked by the technology sector, is down 12 basis points. Micron Technology via MRVL is the bright spot, up 4.7% in the pre-market on news of new AI memory products. Let's look at the broader tech picture via QQQ.
QQQ is at $71.85. It is testing support. The recent daily history shows a low of $71.50 on August 10th. Today it is holding that line. If it closes below that, the next technical support is the low from August 6th, which was $750. The structure is fragile. The 5-day moving average is being tested, and we haven't seen a volume confirmation of a bounce yet. It's hovering on the edge.
Fundamentally, the earnings backdrop for tech is mixed. We have 5 consecutive quarters of year-over-year earnings per share growth for NVIDIA, with earnings per share up 121% year-over-year. That is a massive growth engine. However, NVIDIA news sentiment is bullish, but AMD is showing bearish sentiment. The market is becoming selective. MRVL is moving on specific product cycles, not broad sector tailwinds. The buy the dip narrative in tech is weakening because the growth rates are normalizing after the AI boom.
Sentiment data confirms this caution. The Fear and Greed Index is at 63.7, which is in the greed zone, but the underlying market breadth is narrowing. The AD ratio is at 1.2 to 1, which is rising, but the VIX is hovering around 15.5. The crowd is still optimistic, but the index performance is lagging. Investors are rotating cash into defensive plays like energy and utilities because they are worried about the sustainability of tech multiples at these levels. Let's look at the small cap resilience. IWM is up 34 basis points while the large caps are down. Grid, how does the Russell 2000 technical setup compare to the S&P?
IWM is at $300.99. It is trading near the high of its recent range, which was $301.39 on August 10th. The 10-day range for the Russell is $287 to $303. IWM is holding above the $300 psychological level. The chart shows a consolidation pattern after the recent dip to $298. It is not breaking out yet, but it is refusing to break down. That is a sign of underlying demand.
This divergence is interesting. Small caps are sensitive to interest rates. The Fed funds rate is 3.63%. If the market believes the Fed is done hiking, small caps benefit from the relief of high borrowing costs. The COT data for the S&P 500 E-mini shows commercials at the 100th percentile, which is bullish for the broad index. But the relative outperformance of IWM suggests money is looking for value in cheaper, smaller names that have been beaten down.
But let's look at the risk. IWM is up, but is it a trap? The credit spreads are widening. The BAA 10-year spread is at 1.62%. Small caps are more exposed to credit stress. If the economy slows down, as indicated by the real GDP of only 1.5% annualized, small caps will get hit harder than large caps. The fact that IWM is green while SPY is red might be a dead cat bounce or short covering, not a genuine rotation. Watch the credit markets. If spreads widen further, IWM will likely retrace.
Let's zoom in on the S&P 500 via SPY. It is at $77.56, trading near the lower end of its 5-day range, which is $76.74 to $77.69. Apex synthesize this divergence. Energy and utilities are leading, tech is lagging, and small caps are holding up. What is the equity outlook?
This is a classic defensive shift signal. Pulse noted the Fear and Greed Index is still in greed, but the market action is defensive. Grid showed us that the energy sector is pushing highs while QQQ is testing support. CIPHER highlighted the COT bullishness in commodities and the mixed tech earnings. SPECTER warned about credit spreads and IWM fragility.
So, the key levels to watch. SPY support at $76.74, resistance at $77.69. Triple Q support at $71.50. IWM support at $300. The energy sector resistance at $61.
My call on the Russell 2000 via IWM remains neutral. The small caps are showing relative strength, but the credit risk is too high to be bullish. The data has not changed significantly since Wednesday morning. The 10-day range is still 287 to 303. I am holding at the current price. Reaffirm, IWM neutral, targeting the current price of $300.99 by Friday.
My call on NVIDIA via NVDA remains bearish. The stock is up, but the Roman 4 rank is 99, meaning options are extremely expensive. The market is pricing in perfection. If earnings or guidance miss even slightly, the downside risk is significant. The news sentiment is bullish, but that is often a contrarian indicator when Roman 4 is this high. I am not changing my view. The risk-reward is skewed to the downside. Reaffirm, NVDA bearish, targeting the current price of $219.27 by Friday.
My call on the S&P 500 via SPY remains neutral. The index is at $77.56. The market is balanced between defensive rotation and tech lag. Without a clear catalyst from tomorrow's CPI, I see no reason to change position. The 10-day range is $72.91 to $77.69. We are trading in the middle of that range. Reaffirm, SPY neutral, targeting the current price of $77.56 by Friday.
To recap, energy and utilities are leading the charge as investors seek safety and inflation hedges. Technology is consolidating, with Micron showing isolated strength. Small caps are holding their ground, but credit risk remains a concern. The focus for the rest of the week is the Consumer Price Index on Thursday. That wraps up this edition of ShadowQuant Equities. Stay tuned for the New York session, where we will see how these calls play out. Until then, trade safe.